Hello everyone and welcome to Mirabaud Outlook 2026. As we close 2025 and look toward next year, there is a growing sense that we are living through a historic inflection point. Two forces are shaping it: the unfolding AI revolution and the redesign of global trade and geopolitical order. We will now explore the key trends and factors driving markets, politics, and economic growth. In the very near term, markets seem to question the profitability of massive technology capex. However, beneath this volatility, the underlying trend is clear. The AI infrastructure cycle, from advanced semiconductors to cooling systems and grid upgrades, is still in full motion. Crucially, the bulk of these investments is being driven and financed by companies with exceptionally strong balance sheets. In our view, the cycle is far from peaking. We're certainly not positioning against it. The main binding constraint is shifting from capital to energy. Producing enough stable power and delivering it to data centers without destabilizing power grids. The narrative may be shifting away from sustainability goals towards a more pragmatic priority, ensuring abundant and affordable energy. We'll keep a close eye on it. Geopolitics is often a poor predictor for market performance. Still, today it drives the push to secure essential inputs, prompting countries to nationalize or regionalize strategic supply chains. Western governments are embracing a new form of state capitalism, intervening directly in the economy to safeguard sovereignty. We believe this cycle is only beginning. Aligning with this new paradigm will be essential for performance. Targeted fiscal policy will remain a powerful engine of growth. This push from Washington to Berlin and Tokyo will widen budget deficits and add to already large debt burdens. Yet once again, debt sustainability concerns are likely to be deprioritized in 2026. Stay long real assets. With the midterm elections in November, US politics will once again take the center stage, and world leaders will have their eyes on Washington to see how to position themselves. Those highly expected midterm results might probably depend on how the current administration handles the K-shaped economy issue, one of the main reasons President Trump was elected in the first place. Beyond the positive headlines of strong GDP growth and high stock prices, the bottom part of the case still struggles getting access to housing and funding their businesses. For this reason, the current US administration wants all hands on deck to tackle the issue. We therefore believe the Federal Reserve will have to eventually get in line with the White House and adopt a pro-growth dovish policy, leaving a short-term arbitrary inflation target in the backseat. If they do not, then we will face important volatility in the markets, as well as worrying political backlash. In summary, the Western world is poised to fire on all cylinders to grow through its challenges. Combined with the productivity boost from AI, this supports our broadly positive view on risky assets heading into 2026.
Hello everyone. Let's now dive into the macroeconomic landscape.
So 2026 will be a pivotal moment for the global economy, a transition between post-pandemic resilience and persistent structural challenges. Growth will remain positive, inflation will continue to be a concern in the US, and geopolitical tensions will keep shaping trade and investment flows.
In the US, we expect growth just under 2%, supported by what we call a triple easing: fiscal, monetary, and regulatory. Fiscal stimulus and investments in disruptive technologies, especially AI, will continue to drive productivity gains. Consumption remains a key pillar thanks to household wealth effects, even as job creation slows. But the housing market is a major pressure point. Despite rate cuts, mortgage rates stay above 6%, limiting mobility and keeping supply tight. High long-term yield, despite monetary policy easing, will continue to be a concern for public debt.
Europe faces a different dynamic. Growth will be fueled by fiscal expansion, with deficits widening and public investment reaching its highest level since the financial crisis. Germany is leading with infrastructure and defense spending, while France and Italy navigate political and structural constraints. The ECB is likely to keep rates unchanged, balancing modest growth with sticky service sector inflation.
China could surprise on the upside if announced public investments are deployed quickly, pushing growth above 4.7%. But energy and infrastructure bottlenecks remain, and trade tension with the US over technology and rare earths will persist.
In short, 2026 will be a year of moderate growth, persistent inflation risks, and uneven regional dynamics. Investors should expect volatility and fragmentation, but also opportunities linked to technology and fiscal stimulus.
So let's turn to the US Federal Reserve and politics. The independence of the Fed, a cornerstone of monetary policy, is under pressure. Legal challenges and political interference raise concerns about a shift towards financial repression, keeping rates artificially low to finance deficits. This strategy will help manage debt costs in the short term, but it risks undermining credibility, de-anchoring inflation expectation, and weakening the dollar.
And it's not just politics, it is also institutional. The Supreme Court could allow the president to dismiss Fed governors without cause. Trump has already tried to remove a sitting governor, and Powell's term ends in May 2026. Each vacancy is a chance to reshape the Fed towards a more accommodative stance.
This politicization could mean persistently low rates despite inflation pressures, a strategy history called financial repression. It worked after World War II, but at the cost of credibility and higher risk premiums. We expect steeper yield curves, weaker demand for treasuries, and the dollar under pressure.
We can add to that midterm elections in November. All 435 House seats and 35 Senate seats are up for grabs. If Democrats regain the House, Trump will face legislative gridlock. If Republicans hold both chambers, we could expect more deregulation, fiscal expansion, and tariff-driven trade tensions.
The stakes are high. Monetary policy, fiscal priorities, and even the renegotiation of the USMCA trade agreement. A Republican sweep would reinforce Trump's agenda, while a Democratic comeback could lead to deadlock and market volatility.
Bottom line, political risk is back at center stage. It matters for rate, the dollar, and global trade. Investors should prepare for scenarios where policy uncertainty drives volatility. So what does this mean for portfolios? Our central scenario remains Goldilocks, moderate growth and inflation. Risk assets will be supported, but upside will be limited. US earnings growth should reach 14%, driven by tech and AI. These valuations are high, but they are backed by strong and sustainable earnings over the next 3 to 5 years.
AI adoption could add 1% to labor productivity, making US tech exposure essential. In Europe, fiscal stimulus and a cyclical rebound favor industrials and small caps, while Swiss small and mid caps should benefit from stronger European demand.
On fixed income, we expect further steepening of the US yield curve as short rates fall and long-term risk premiums stay high. Corporate bonds remain attractive, supported by lower default rates, while emerging market debt benefits from a weaker dollar.
Diversification will still be key. Gold and Bitcoin act as hedges against inflation and credibility risks. Both assets protect against financial repression and dollar weakness. We also like hedge funds with directional strategies.
We stay cautious on the dollar. The Fed's rate-cutting cycle isn't over, and political uncertainty adds pressure. Meanwhile, the euro should benefit from Europe's recovery, and the Swiss franc remains strong.
In short, 2026 offers opportunities, but navigating volatility and political risk will require discipline, selectivity, and a focus on structural themes like technology, real assets, and alternative strategies. Thank you for watching our 2026 Outlook series. We hope these insights will help you navigate the year ahead with confidence. Stay tuned for more updates from Mirabaud.